All right, well, I'm going to go ahead and get started. So welcome to my first monthly home buyers webinar and mastering the home buyer process. My name is Sean Woland, and I'm a local mortgage banker. This is my 24th year now doing home loans. And my goal with this is to really arm you with everything you need to know when preparing to buy a home and when shopping for a home, so that you can have all the ammunition you need to make the proper decisions moving forward and really set yourself up for success. So let's go ahead and get it started with my typical sense of humor, which is, I think, hysterical. But let's have a look at that first of all. So here, what do you call a woman that burns all of her mortgage statements and documents? We call her Bernadette. I know, it's terrible. Terrible. On that note, here's my team. I want to give you guys a quick overview of who we are. Myself on the left, I am the mortgage strategist. I am the manager of the branch as well. Sandy Richards and Heidi Kane are my loan partners. They are instrumental in the pre-approval process to help our customers really get set up for success. Capri is my operations manager. Early is on time. She's the one that manages all of the closings to make sure everything goes smoothly through our processing and underwriting. And then Christy Varga is our business development. She helps spread the word of the good news of the Woland Mortgage team. So we have, between us, we have over 100 years of experience. That is incredible because in this industry, experience is everything, and really helps when there's tough transactions to know what to do to get through to the other side. So the agenda, what we're going to go over today, here's a quick little agenda for you. We have the first thing we're going to do is busting some mortgage myths. Then we're going to be looking at some loan programs that are available. We're going to be looking at, is it better to buy versus rent? Is it a good time to buy? What does it take to qualify? How to calculate payments, what the credit requirements and some credit tips, how to shop for a mortgage, understanding how rates work, so you really understand when you're getting a quote, what you're asking for, an overview of the actual process, how do you get started. So let's check out some myths first of all. I love myths. Myths are a lot of fun. Mythbusters is a good show, by the way. So myth number one, 20% down is required to buy a home. This is completely false. Believe it or not, a lot of people still think 20% down is required. 20% down is required if you want to eliminate completely the mortgage insurance part of it. But the truth is, you can buy a home with zero down. In fact, you can do zero down up to $1 million purchase price. So we've got a lot of programs for you for that. Another common myth, you need 2 years at the same job to qualify. I've had people tell me all the time, you know, I need a couple more months here on my job in order to qualify. And that's not the case. You need all you need is an offer letter with a salary and a start date at a new job. You don't even have to be started yet to use that income to qualify. The key here is you need job history. So you need to show that there's at least 2 years worth of history at any job. It could be multiple jobs. And we just need to show that you have the ability to continue to work. In fact, college and trade school can be used as work history. So if you're in college and you want to buy a home the day you get into a new position or the day you get a new offer, you can use your college or your trade school as work history to qualify. Now, if you're self-employed, you do need to prove yourself for 2 years that you can run your own business. And that's where 2 years tax returns. But that's the only thing, that's the only type of a job that would require 2 years in the same job, self-employed. So let's look at another one. All lenders are the same. If you ask every realtor out there, they're going to tell you that is definitely not true. There's massive differences. I mean, we can go over them in a lot more detail later, but banks are very strict. A lot of the loan officers are newer. They go to a bank to start. Mortgage brokers, they have the least amount of control, but they do have a lot of options. But they send the loan out to be processed somewhere else across the country, could be in any state. Mortgage bankers, that's what we are. We do everything under our roof. Everything is in control. We're also a mortgage broker. And then credit unions. Credit unions are small models of mortgage. Usually they farm out their mortgages for somebody else to fulfill for them. But they are much smaller, usually newer loan officers as well. So let's look at some other busted myths. great credit is needed to qualify. This is absolutely not true. But if you don't have good credit, then you can always go to FICOBoost.com, which is my website. And it's a site that I've prepared to help anyone that needs boosting of their credit scores to purchase a home. We will do a free analysis for you. But mortgage products are down into the 500s. So FHA will go into the 500s, VA in the 500s. So there are possibilities for you if you have bad credit. We just need to show some strength, some additional strength, some compensating factors. So a lot of the questions I see are, should I rent or should I buy? So what I've done is I've put together some scenarios and I've showed side by side what it looks like for two different properties that are the equal square footage, same area, basically the same everything based on renting versus buying, what those prices are. So let's start with a couple questions here though. What are the benefits of owning a home? So when you own a home, you decide when you move, not your landlord. So you're not going to get oh, by the way, you need to be out in 2 months because I'm selling the house. You'll never get that call. You create family stability. That's very important, especially when growing a family. You can track your kids' growth. I've loved this one. You can track your kids' growth on the door frames. You know those little hash marks you make every 6 or 7 weeks, you kind of see how much they're growing. That's one of my favorites. You can control your monthly housing payment. You can't control it if it's rent. Rent goes up every year. You build home equity with every payment you make. Your home value will rise over time, and we'll look at this in the future. There have been very few times where it hasn't. We'll go over those as well. You can use your home equity to build wealth. Lots of options there. There's tax benefits. You build credit. And you can make the home your own. So let's look at the truth in the numbers, because the numbers really do not lie. Let's look at this one real fast. So this right here is a home that was, I stole this from Zillow. Yes, Zillow is not a good place to go to. Always go to a realtor, but at least it's fast information. This was a home that's rented for $4,500. This is a similar home. It actually, I think, is kind of a little bit nicer, a little bit better curb appeal for $650. So let's look at bedroom count similar. The home square footage was similar. Let's look to see what the costs are and whether it makes sense to rent versus buy. Now, this takes into account a lot of different things. Obviously, you're buying year one, you've got some upfront expenses, and what your payments are right here, you're at $49.73, whereas rent is $43.05. However, you're paying yourself and you're creating equity. So we need to make sure we're looking at that as well. And that's where we look at these numbers to the side on the graph. So as you see, rents go up where the mortgage stays the same. Now, appreciation is something you have to take into consider as well, and amortization gain. This is how much you're paying yourself over the 10-year period. So overall, with rents increasing at the normal pace, and if you're renting right now, you know rents go up, you will have a cash flow difference of a positive $80,000. And here's the actual graph of your net gain by buying a home. The third year, you would have gained $25,000 over renting, and up to the 10th year, you would be positive $396,000 better off by purchasing instead of renting. So that's one scenario. Let's look at the next. So this is a smaller home, rent $2,200 a month, or you could buy a similar home right up the street for $324,900. So let's look at that. It's the same scenario. Yes, the first month, it's a little bit more. However, over time, rents go up and you're paying yourself and you get appreciation gain. So look what that looks like over time. Over a 10-year period, that's $110,000 appreciation. And that's only at 3%, guys. That's really low appreciation that we're gauging this on. And then what you're paying yourself, $52,000. So overall, the third year is where you start breaking even. This takes into consideration if you sold the home within this time period, the cost to sell with realtor fees, it brings in everything. So third year, you start to really crank it up. And over a 10-year period, you're up $200,000, double or almost double what the value of the home is. So definitely the rent versus buy for long-term is absolutely a win-win when you own the home. Now, if you're only going to be in the home 6 months to a year, and then you're going to be moving to a different state or something, that may constitute a rent position. or you could buy it and then rent it out and make money on that when you leave. So lots of options there. Can we see the benefits list one more time? Would love to grab it. I'm going to have this recorded. I'll send it to everybody, and you can grab screenshots on this as much as you want. So another question is now a good time to buy a house? I mean, rates are higher. It seems like values are higher. Is now a good time to buy? Well, if you've been paying attention this last 4 to 5 months, we have seen a little bit of a drop in values. It's been about 3% roughly, which is not huge, but it's because people are paying through the nose. I mean, absolutely incredible amounts, right? To buy a home about 1.5 years ago, they're going over asking. So now we've tucked it down about 3%, but guess what, guys? We're seeing appreciation happen again. This month we saw appreciation go up. And why is that? It's all about supply and demand. As long as the supply is low and the demand's high, we will continue to see appreciation in homes. So let's look to see at some of the really interesting graphs that are out here. Now, here is completions. Completion is the orange. Those are homes that are built by builders. Builders are building them. And then the formations, these are households that need a home. If you have kids that are growing up and moving out and need a place to live, that's a formation. So these are people needing homes, and these are the supply of homes being completed. As you can see, in 2006, there was more homes than what was needed. There was an actual population shift here, and there wasn't as much population growth at the time. So this correlates 100% with that. So the builders got ahead of themselves, ahead of their skis. They thought the population was going to stay the same. It didn't. And now we see an oversupply, and we all know what happened in the 2008. When there's too many homes and not enough buyers, you have to lower the price. And then we also saw a lot of foreclosures and a lot of bad loans. But that's that. Now look at, compare and contrast where we are today. We've had more population growth and households formed than homes being built. And we've had more homes, or we had more people needing homes than homes being built for a number of years in a row. This has put us in a predicament. There are not enough homes. So when you look at whether or not it's a good idea to buy, look, if you buy now, values are going to stay strong moving forward because there's more people that need a home than there are completions, supply and demand. Here's that, the stats and the evidence and where this information came from. The overall, the appreciation was down about 2.95% from the peak in 2022. But right now, guys, we're up. We are up month over month. We're 4.4% year over year forecast is what everyone's saying. So we're in the positive now. So it's a great time to get in to buy a house right now because you will get appreciation and sellers are still giving discounts. And we can go over that in a little bit more. But sellers are willing to give you money to pay closing costs and to do rate buy downs, which is a very good way of getting a lower rate, because as we know, rates did go up. But if the sellers are willing to give you money to buy the rate down to get a nice low rate, it's good. But once everyone that's waiting right now for rates to come down, and rates are coming down, once they all jump in, it's going to be crazy and you're going to have multiple offers and it's going to be harder to get a good deal. So let's move to the next slide here. This is what I call the Mike Tyson, the champ, right? These are the appreciation numbers since 1942 of real estate. We are 73-7-1 with appreciation. Now, we had a tiny little drop here. It was break even here. And then this was what we all know what happened here with all the foreclosures with the oversupply. And look where we are since. So guys, it is a great investment to get into real estate. It's a winning bet. If I was going to bet on this person, I would bet on them every time. And that's what real estate's done. So really consistent. So what does it take to qualify? The most important things to qualify are credit scores. So you have to be at a certain credit level to be in the game. You have to have something in the 500s for FHA or 620 plus for conventional. Jumbo is a little bit higher. Cash, you need cash, but You don't always need it. We do 0 down loans up to $1 million. So if you're somebody that is straight out of college, you have a good job, but you just don't have the money, you can buy a house right now. So cash, you may think you need it, but you may not need as much as you think. Job history, 2 years of work history is all you need, and that includes school. You don't need to be on the same job 2 years. You just need to have history for 2 years. Income is absolutely the most important to know how much you qualify for. Here's a quick formula for you to write down. Take notes on this. For the most part, your total debts, including the new mortgage, can't exceed 50% of your income. So if somebody making $10,000 a month asked me how much they could qualify for, it would basically be all of their monthly debts added together plus the mortgage can't exceed $5,000. So if they have no debt, you're going to be right around or close to the $5,000 payment is what you could qualify for. That's a good ballpark way of figuring out how much you can qualify for. If they had a $500 car payment, then they would do $4,500 mortgage, $500 car payment, and that's a 50% DTI. So that's a rough number. Different loan products have different debt to income requirements. And we can go over that in more detail on a one-on-one basis. But here's your debt to income for the most part. Conventional up to 50, FHA goes up to 55, VA goes up to 65, even higher. It's based on residual income, not debt to income ratios. So it allows higher. If you're a veteran, we can talk more about that. Jumbo, a little bit more strict. That's anything over 726,200, 43, and same with USDA, right around the 43. So income is very, very important. If you don't have a job, most likely you can't get a mortgage, but you can ask somebody that has a job that's a family member to co-sign for you, and then you can get a mortgage. We add it all together. So co-signing is a very big way, right here, co-signing a very big way to help you qualify if you're lacking in any of the above. So let's look at how you do mortgage payments. On my website, if you go to my mortgage calculators at woolenmortgageteam.com, there's a whole tab called mortgage calculators. You plug in the type of loan, your purchase price, how much you want to put down, your interest rate. It'll break down everything for you to calculate what your monthly payment would be. This is just a calculator that doesn't tell you how much you qualify for. You need to talk to me first for that. But this will give you an idea of what the payments would be on any specific home. So if you ever want a mortgage calculator, just go to my website, woolenmortgageteam.com. There's a slew of mortgage calculators for you. But to make it simple, there's a principal and interest payment. There's a property tax payment, mortgage insurance, and homeowner's insurance as part of the total payment that you're going to have on your home. So there's a little bit involved as far as how much you have to calculate, and that's what I'm here for. So programs, you might say, well, what kind of programs do you have, Sean? Well, we have all of them. And the reason I say all of them, we have a lot. And here's the generic ones. Conventional, there's 0 down programs with the programs that we have. That is a 680 minimum. So this just breaks down the credit score requirements, but there's conventional, FHA, VA, USDA, and then there's the Native American HUD 184 loan program for Native Americans to purchase homes with a special program as well. So all of these programs are available. These are the generic ones. But guys, we have a whole slew of additional ones, which I call our niches. So this is our nichometer. It goes over a lot of the different programs, the 0 down programs that we have. We have 1% down community heroes programs. We've got 3% down home style renovation programs. We have FHA, we've got jumbo, we've got every mortgage product under the sun. So what we do is we analyze everything that you have, your income, your debts, your credit scores, how much money you have for down payment, and we figure out which loan product would be best for your circumstance. So let's look at credit scores, because credit is one of the most important pieces of qualifying, and it's very important for your rate. Rate is what credit scores determine your rate for the most part. Program types have different rates, but for the most part, credit scores will determine your interest rate. So it's really important. So here's some tips. When you're getting pre-qualified, request a soft credit pull. This doesn't have any impact on your credit report, and it allows us, the lender, to at least peek in to see everything that's going on. So that's the first step when getting pre-qualified. keep your credit card balances at 30% or low of their maximum credit limits. That's very important because if you max out your credit card, it's going to really impact your credit scores for the worse. Even if you pay them off every month, when we run that credit score, if your balance is high at that time, it will reflect that. So make sure you're keeping your balances nice and low. Do not go late on anything ever, guys. Seriously, that is super detrimental. 50 to 100 points off your credit score, like that. One of the things that is a total myth is you should close your credit cards that you're not using. That is totally false. You need to keep them open for as long as you can. Open credit lines over a long period of time help build your credit scores higher and higher and higher. So credit reports, credit scores are nothing more than a report card on how well you manage open lines of credit. If you keep closing them out, there's nothing to grade. So keeping them active for a long time is very, very important. Would it be helpful to call and request limit increases? You can do that. So if you have a credit card that maybe you're using more often, increasing that credit limit will allow you to jump in and have if your balance was 3,000 and your max was 5,000, if you increase that to 10,000, like that, you've got a lower ratio now on what you can borrow and your credit score will go up. Very good tip there, Melissa Gasper. As always, you are a smart cookie. Pay off any collections. So collections are tricky. If you have a bunch of collections and your credit score is okay to qualify, leave them alone. However, if you're preparing to get into a purchase and you want to clean up your credit, paying them off will actually negatively impact your credit at first. And then after time, your credit will build back higher rapidly. But any active account on a negative account, active activity on a negative account will cause your credit scores to come down. So if you make a payment on a charge off, it's new activity on a negative account. It's weird. That's how it works, but that's how it is. So you have to do that ahead of time, wait a few months, and then your credit scores will go up. Secured credit cards. If you don't have any credit, you can go to your bank and say, here's $300 cash. I would like a secured credit card, and I want you guys to report it to the bureaus. They'll give it to you no matter what, even if you have no credit. It's a guaranteed acceptance as far as getting approved for a credit card, because it's your money that you're securitizing the loan against. So the bank doesn't care, they have no risk. That's a great way to get started on building credit. Another trick is if you have any grandparents or parents that have credit cards that have been around for a very long time, you can get added as an authorized user and instantly gain the history and the credit reporting for that account. It's an instant way of getting your credit score boosted very quickly. You can also self-report utilities. So if you don't have any credit, you can actually self-report your Verizon Wireless, your electric bill, all of those items to help build your credit. So if you don't have credit, this is a great way of getting your credit up. And again, my personal favorite, FICOboost.com. So if you're looking to buy a house and you just don't know where to start, let me do that for you. I will review your credit for free. I'll give you a full plan on what you need to do to boost your credit scores to be able to purchase. And then eventually you'll be there to be able to buy a home. So one of the tools that I love, or one of these quotes that I like is good old Dave Ramsey. He says, live like nobody else now so you can live like nobody else in the future. Essentially what he says is, don't spend $1,000 on a car now when you don't make a lot of money, when you're just trying to show off a nice car, when you're trying to buy a house. Get a beater, get something cheap, save up your money, you buy a house first, and then you can afford after that, once you get your feet once you get everything going, to buy that more expensive car. Because debt to income ratio, guys, if you have $1,000 payment on your car, that takes away $1,000 worth of mortgage. So if you don't have any payments on your car, you'll afford a lot more than you do if you have a lot of big payments. So try to live frugally now so you can have a lot of wealth building in real estate and live like a king later. So shopping for a mortgage. This is my favorite. People just don't know how to shop for a mortgage. All they say is, what's your rate? Rate is important, but it's a very small percentage of what is very, very, very important for the whole entire process. So let's get into this. Shopping for a lender. Here's some tips on how to shop for a lender. First, ask how long the LO, loan officer, has been originating loans. If it's less than a year or two, probably don't have very much knowledge. They probably don't know all of the rules. There's thousands and thousands of pages of rules on all of the different mortgage plans, mortgage programs that are out there for Fannie Mae, FHA, Ginnie Mae, like all of the Freddie Mac, Jumbo. I mean, everything is different. So we need to know all of it. It's like attorney. You need to know all the laws, right? If they're young in the industry, they may not understand them and they may run into problems. How is the LO ranked nationally? We are all ranked nationally in some way or the other. Luckily, my team is ranked top 1% in the country for the last 7 years. So if you hear something like that, you can know you're in good hands. Are they licensed or just registered through the FDIC? This is very important. A licensed loan officer like myself goes through a lot of schooling, a lot of education every year to be top of our trade, whereas a loan officer at a bank may just be registered through the FDIC and not have to get any of that licensing or any of that education. So it's important to know what the loan officer's education is because they're handling the biggest financial transaction probably in your life. Do they have a CMPS designation? This is a certified mortgage planning specialist. This is a very hands-on week-long class that goes into deep on how to use the mortgage as a financial tool in the overall picture of the person's financial world. So if they have a lot of money in stock, if they're liquidating a lot of money to pay for a mortgage, helping them make the best decisions by knowing how to use that in their total financial picture is what that is. And of course, yes, I do have that. Are they available after hours? Guys, real estate, most of real estate happens after hours and on weekends. You can't do it all when you're working. And most banks, most credit unions are just open 9 to 5. So a private mortgage banker like us, we are self-employed. We live 24/7. You guys know how it is. If you need to call me at Saturday at 9 a.m. to get a pre-qualification, we will be here. So make sure they're available on weekends, holidays, after hours, because it's important. Are they a broker, bank, or a mortgage banker? This will tell you everything. If they're a broker, they may be working out of their house. If they're a bank, they may be very restricted. If they're a mortgage banker, they probably have a lot of options. In fact, guess what we are? We're a mortgage banker. We're partnered with the bank, Waterstone Bank, and we're a broker. So we're literally all three. So we've got everything that you need, but it's a good idea to ask what they are to pinpoint what type of a transaction, if they're going to be sending it out to a bunch of different other lenders to do your loan and sending all that information out to other people that maybe you don't know. It's important to know. And how do you decide what day to lock a mortgage rate? Mortgage rates move every day, minute by minute. So if the lender does not know when or how to lock a mortgage rate or how they decide to do it, ask them, how do you decide when to lock? And if they say, oh, whenever you're comfortable, wrong answer. What drives interest rates? Ask them. What drives interest rates and make them change? If they can't tell you that it's mortgage-backed securities and the bond markets and how they move, run, because they won't know when to lock your mortgage and they may lock you in at a higher rate when rates are dropping. Pros and cons of paying points. Ask the lender what the pros and cons are of paying points when you're applying with them. It's very important to get a breakdown of that. Ask the lender if they do float down options. If you lock in the rate and rates are dramatically lower, a week later, will they give you a float down to that lower rate? Very important. What kind of tools do they have to compare loan programs? So they should have the ability to put multiple loan programs before you to show you side by side what that looks like. It's imperative to be able to understand what you're doing, whether there's with points, without points, what's the short-term and long-term benefits. It's important that they'll be able to outline and compare those loan options side by side. And what kind of lifelong mortgage optimization program do they have? Are they just going to do the loan and forget about you? Are you going to be one of the millions at the bank where nobody will call you when it's ready to refinance? Or will you be with a lender that manages that for you and sends you out reports every month that says, okay, now's a good time to potentially refinance. Here's how much you could save. It's important that you have a lender that manages this for you. What kind of unique programs do they have to help you? Like our zero down program up to $1 million. Do they have something like that? Ask them how many days they need to close. If it's 20 to 30 days, perfect. If it's, well, we can probably do it in 45 days, that's not going to work. Sellers don't want long closings. They want their money quickly. Ask the loan officer when you can lock the rate and if they have a lock and shop program. So if you go through our platinum approval process, which we'll talk about shortly, you can lock your loan before you even find a property. Most lenders don't have that. So it's a great tool to have if we're in a rising interest rate environment. And lenders that are referred by a realtor, we have a vested interest in making sure that this loan goes very smooth, because we have a realtor that we're trying to impress as well, because we want them to continue to refer business our way. If it's just somebody at the bank, they don't really care. They're just going to do it their way. They're not going to bend over backwards to make sure this is the best absolute service that you're getting. They're not going to do it. I promise you, it happens all the time. And if the loan officer is not me, Sean Woolen, then run. I'm kidding. That's my humor. Gotta love my humor. So let's look at some more, how to shop rates, because this is probably the most important piece that people don't understand. You always have to compare rates on the same day. You cannot get a quote on Monday and then go about your busy week, get another quote on Friday and compare them. The markets will change crazily in between. Rates will go up and down all over the place in that 5 days. So that is not an apples to apples comparison. You will not get a good comparison. It'll do you a disservice if you do it. So always compare them the same day. If you have a couple people, give them a call, set an hour time block out and say, okay, I'm going to call these to get their quotes for the day, or just shoot them an email and say, give me your updated quote for the day. But has to be during that day, and make sure they're giving you options and showing it side by side. Always get it in writing. No email that says our rates are 5.25. If they don't show you the fees involved, the APR, run, because they have to. It's the only way of knowing. I can quote a rate today. I can say, yeah, our rate today is 4.5. But if I don't tell you that, oh yeah, by the way, you have to pay $25,000 to get that rate and extra fees, it's going to really bite you in the rear end once you see everything and commit to that lender and you're like, oh my gosh, I didn't know there was all these points. The internet is riddled with this disservice. It's always in the fine print. It's hard to find. So you see a rate, you get excited, you think that's the rate for the day, and then you realize there's lots of other points and fees involved. So compare rates, the lender fees, and the points. But guess what? The third-party fees, do not compare them. If I say my escrow fee is $1,200 and somebody else says theirs is $500, we're not going to know who that escrow company fee is until you go into contract. And no matter who you use as the lender, it's probably going to be the same title company either way. So the lender has no choice in that. Make sure you compare equal lock terms. Did you know that locks are cheaper if you lock in on 15 days versus 30 or 45, 60, 75, 90? The longer that lock term, the more expensive the rate. So make sure they're not giving you a 15-day rate quote. It'll always look better. Pros and cons of different rate and fees combos. We've talked about that. Make sure they're outlining that for you side by side. And the lowest rate option is not always the best choice. Here's a quick story. I had a gentleman saying, I want the lowest rate possible. I want to pay 1 point to get it really low. I want my payments to be this. And then he told me, I'm probably going to be paying it off in 6 months. So I said, well, why would you pay $5,000 to save $150 a month when you're only going to be in there 6 months? So you're only going to recoup like $800 and that's it. You're going to lose $4,200. So I was able to get him a rate that was higher, that paid for all of his closing costs. And he was very happy that I told him that, because the other lender did not tell him that and just followed his orders. So it's good to have a really good loan officer to be able to really dig into why you need and why you're asking for those rates. What are the lender's fees for refinancing? So if you buy a house with me right now, what are my fees going to be when rates drop in 6 to 12 months? Well, with mine, my lender fees are 0. So ask them, see what their lender fees are. Now, how do mortgage rates work? This is like, this is like the Wizard of Oz, behind the scenes. Who's behind the curtain, right? How do mortgage rates work? How are there so many different rates online? Let's look at this. This is a rate sheet. This shows you what rates are available today and what the costs are, okay? So if somebody says, yeah, we can do a rate at 4 3/8, and you're like, oh my gosh, that's such a better rate than Sean. He quoted me 5 1/8. If you don't look at the points right here that you have to pay, the out-of-pocket costs for these loans, you are going to be dumbfounded when you see the estimate. Might be too late. You might be under contract, moving forward, and then you're like, oh my gosh, I didn't read the fine print. And now you have all of these really expensive loans. So what I do is I take, let's just say a rate of 4 3/4. I'll do 5 1/4. Maybe I'll do 5 3/4, and then I'll do 6 1/4 or 6 1/8. This one down here, look, this one I'm giving you $2,060 for this rate. This rate right here today is the closest to what we call par, no points, right? You're going to get a credit of $105. Anything below here, anything in this range right here, all of this is going to cost you extra money. Yes, you can get those rates. You can get them all day long, but will it cost you? You betcha. And so if you're just saying, what's your rate? And somebody says, today our rate's 4.875 on a 30-year fixed, they will be telling the truth, but they're not telling the whole truth, that that's going to cost you on this one $11,900. Now it's a point is a percentage of the loan amount. So if it's a $500,000 loan, 1 point would be 1%, which is $5,000 of that $500,000 purchase price. 1% is $5,000. So that's how you know how much a point is. 1 point is 1%. 2 points is 2%, and it's always of the loan amount. So just a little tip there. So that's behind the scenes, guys. A lot of people do not get to see this. They don't know how it works. So that's why you see all of these different rates on bank rate. Everything's so different. You wonder why these people have such great rates. This is how it's done. So here's some questions. So anyone with any late payments should not bother applying for a mortgage. No, that is not true. If you have late payments, you may have a lower credit score. And that's where FICO Boost comes in handy. But if you're trying to optimize your credit score and you think, oh, going late 1 month is not going to make a difference, it's going to make a huge difference. All right, so how does the loan approval process work? Like, what does that look like from start to finish? Let's look at that in detail. There's 3 distinct parts. There's the initial pre-approval process that's done directly with the loan officer. And that's where the loan officer takes the application. They go through all the information, they ask for your documents, and they give you a pre-qualification. Then there's what we call the platinum loan approval. That's a fully underwritten, all the way through the process, loan approval through underwriting. And it's before you find a property. And then the final loan approval process, that happens at the very end, right about when you're ready to close. So there's 3 distinct parts of it. And let's look at the pre-approval. So you complete a loan application. I say do not ever do it online. Yes, you can do it online, but it's garbage in, garbage out. You don't know all of the rules and the laws on how we look at income and how we look at different things. So if it says, what's your income, and you pay yourself a W-2 when you're self-employed, you may just say, yeah, I'm $120,000 a year. I pay myself W-2. That's my income. However, if you're self-employed and you don't put that in there because there's no place to put that on an online application, it will bite you in the rear end when you see that your actual tax returns show a loss. So online applications, I don't like them. I think you should meet face-to-face, do a Zoom call, a phone call to really make sure that application is done properly so it's not garbage in, garbage out. So when your credit is run and we do a credit review, that's part of the pre-qualification process. So a loan officer will run your credit, hopefully during a soft pull, look at everything and analyze that to see if you're credit worthy. So if it fits the rules for the mortgage products that you're looking to get. So credit score is one piece, then the rest of it, credit history, if there's foreclosures, if there's short sales, if there's charge-offs, if there's student loans that are in default, all of that is on your credit report. But if you just look at the credit score and you don't look at the report, you may go into the transaction thinking you can qualify for and just to get really beaten up. So a full credit review is needed and the loan officer has to know how to do that. Review of all income history and documents. So all of your W-2s, your pay stubs, your tax returns. If you have 15 different companies that you own, guess what? We need to work with your CPA to get all of those corporate returns, all of those S-Corps, all of that in, all your K-1s, everything in, and review it just to make sure, because the mortgage world is black and white when it comes to the rules. And we need to make sure that your income is true, and that when it gets to underwriting, that we're reviewing it as an underwriter would. So we need to review all of that up front. Review of assets, we need to make sure that money's been in your account for at least 60 days. There's a lot of anti-money laundering laws in the United States. So the rule of thumb are, if you have cash, it can't be used unless it's in a bank account for at least 60 days. Otherwise, you can't use it. So there are some tricks to that. I could talk to you about that. But for the most part, you cannot use cash in a jar or under your mattress for any real estate purchase. So making sure the loan officer knows where the money is, when it's coming, where it's coming from, if there's gifts involved, is very, very important to the outcome of the loan. And then every mortgage company, for FHA, VA, conventional loans, we all run them through a program. It's an AUS, Automated Underwriting System. It is an automated system. It's online, and it will analyze your credit report and everything we put in the application to give you an approval. Once we have that, and we have validation and verification of everything, and everything's perfect, you are good to go. And then that's when we have our platinum loan approval on our side. We will get it into underwriting, and we'll have that done for you, so that you have a really solid sense of what you can afford. So that's the platinum loan approval. We get everything into underwriting. We have all of the conditions cleared. So literally, your loan is clear to close, and all we need is a property. So if you're looking to get pre-qualified, you want to get everything out of the way up front, because planning early makes things a lot more easier. There's nothing worse than digging through boxes to try to find something that your lender needs a week before closing. So we try to get this clear to close, and we get that right up front, so that all you need is to find a property, attach the property to your loan, and close in 2 weeks. So another perk, if you go through this platinum loan approval, you get a $500 lender credit to take care of some of your closing costs. So there's a perk to not only getting it done early, but monetarily as well. This is the overall process. So during a loan, if you went to one of these big lenders and you hit a button to get mortgage, they're not going to ask you for everything up front. They're just going to spit out a basic pre-qualification online. They've not verified or validated anything. You go into contract, and then you have to go through every single one of these processes. They have to process the loan. They have to do the underwriting. Then they conditionally approve it. Then they will clear all the conditions. They get the clear to close. Then they send it to closing, and then they fund the loan. That's how a normal process is done. We do this up front. We do this up front. We do this up front. And we get you all set up here. So when you find a property, all you have is 3 steps. So that's the main process of who is involved. There's loan processors, there's underwriters. Underwriters will get the conditions cleared with our team. Once they clear all that, that means you're clear to close. There's nothing standing in the way of you getting that loan or that home. And then we send it to the closing department to print out the loan docs. Then your loan is funded. This typically is about 30 days. So if somebody says it's longer than that, it's not, they're just not a fast mortgage company. So let's get started, right? That's the next step. So the next step in getting qualified is to do an online application. So here I am. This is my information. You can reach me anywhere around the country at 888-SEAN-777. I know it's kind of cheesy, but easy to remember. And this is my office line, and then my cell phone. I'm always available on weekends, and I'm always available should you need anything. Questions, if you have another lender that you want to just check on, I'm happy to look over their estimates as well. Here's a question real fast. How far through the loan process can you go without actually having a contract property address? You can get a clear to close, basically, without a property. So you can go all the way through the process and clear all conditions and have it ready for a property. And then 2 weeks is the fastest you can close because of the regulatory waiting period times involved with the transaction. But literally, clear to close. It's a great tool. But if you are looking to get started, I would love to help you. I've been doing this a long time. This is my 24th year. On the back right there, there's some awards as top 1% in the country in the video here. I really hope to earn your business. If you have any questions, just shoot a quick call to me, a quick text. I'm here to help. I've been doing this a long time. I've got a great team, and I really look forward to helping you guys. I hope you've learned a lot through this little webinar. This is shareable, so you can send this to anyone that you might know that's looking to purchase a home. And if you have any other further questions, I'm a phone call or a text away, guys. So thank you so much, guys, for being here today. I really do appreciate your time. And if you have any questions, I'm going to open that up right now in the Q&A. And so go ahead and jump in and ask some questions. So we have, how long is the clear to close good for? Then without resubmitting items in credit pull, the credit report is good for 120 days. If it goes past that, we would have to refresh credit, and then it's just a quick update through our system. There are some updated, if more than a month goes by or more than a couple weeks goes by, we'll update like a recent pay stub just to make sure they still have a job. And we'll still do the last minute verification of employments just to make sure they didn't quit 1 day prior to closing, which is another thing we do. We warn our customers. We have a do not do list, right? Do not quit your job. Do not get a car loan right before you're trying to fund a loan. So there's a lot of things that could pop up, but good question. It could be a couple weeks, but we may need a few things if it goes longer than that. But it is clear to close. As long as nothing changes, they're still good to go. Credit report, good for 120 days. Any other questions? All right, guys. Well, thank you so much for being here today. Really appreciate it. And feel free to look me up. I've got lots of Google reviews as well, and I look forward to serving you.